September 22nd, 1985. Inside the Plaza Hotel in Manhattan, the most powerful finance ministers in the world gather beneath chandeliers to do something that sounds almost impossible. They are trying to weaken the American dollar. That should have made no sense. The United States was the largest economy on earth. Wall Street was rising. The Cold War order was still intact. A strong dollar was supposed to mean strength itself. That is the story ordinary people are always told. Strong currency, strong country. Expensive money, global respect. A rising dollar sounds like a national compliment. But by the time those officials met in New York, the compliment had become a warning. The dollar had climbed 44% against other major currencies in the 5 years leading up to 1985, and the U.S. trade balance had sunk to record deficits. The stronger the dollar looked on trading screens, the more damage it was doing to the economy that issued it. That is the hidden reversal at the center of this story. A powerful currency does not always signal a powerful middle class. In fact, across modern economic history, some of the most punishing periods for workers, producers, and ordinary households arrived precisely when a country's currency was being treated like a symbol of prestige, safety, or monetary virtue. The real question is not whether the dollar is strong. The real question is why it is strong, who benefits when it rises, and what kind of country has to become weaker at home in order to look invincible from abroad. Because the dollar's strength can mean something darker than prosperity. It can mean global capital trusts American paper more than America's productive base. It can mean the world is buying treasury debt, bidding up financial assets, and hiding in U.S. markets while wages, industry, and homeownership erode underneath. It can mean the nation is becoming more useful as a vault than as a society. And this is the part most people miss. The United States does not live under a normal currency. It lives under the world's reserve currency. That distinction changes everything. In 1960, economist Robert Triffin described the contradiction with devastating clarity. If the United States stopped running deficits and stopped supplying dollars to the world, global liquidity would tighten and the international system could contract. But if the United States kept sending dollars abroad, confidence in the dollar itself would eventually weaken. The world needed American deficits for the system to function, yet those same deficits carried the seeds of instability. The reserve currency issuer had to serve the world and itself at the same time, and those goals were never perfectly aligned. That sounds abstract until you translate it into lived reality. To be the issuer of the dominant currency is to be pressured into supplying safe assets, deep bond markets, liquid financial plumbing, and a constant stream of dollar claims the rest of the world can hold. In practice, that often means chronic external imbalances, powerful capital inflows, and a domestic economy increasingly shaped around finance rather than production. A nation like that can appear strong even while it becomes dependent on the very forces hollowing it out. It can import more than it exports because the rest of the world wants its assets. It can sustain large debt loads because its bonds are treated as the closest thing to global collateral. Its consumers can enjoy cheaper imports for a time. Its asset markets can levitate. Its currency can rise in moments of fear because everyone wants access to the same shelter. But a middle class does not live inside an exchange rate index. It lives inside wages, housing, debt service, healthcare bills, local taxes, childcare costs, and the bargaining power of work. And reserve currency strength often presses directly against those foundations. When a currency rises sharply, export industries lose price competitiveness. Tradable sector jobs face pressure. Investment flows toward finance, consumption, and asset arbitrage instead of long-horizon production. Policymakers become more sensitive to protecting bond credibility and capital market stability than to protecting wage growth in exposed regions. The gains are diffuse, indirect, and often captured at the top. The losses are local, visible, and social. History has shown this before. Long before the dollar carried this burden, another currency did. London, 1925. Britain, still haunted by the memory of imperial supremacy, decides to return sterling to its pre-war gold parity. It is a prestige decision as much as an economic one. The pound must look strong. The old standard must be restored. The City of London must reaffirm its credibility. To the financial establishment, a hard pound is proof that Britain remains Britain. John Maynard Keynes saw the trap immediately. Britain, he argued, was restoring the currency at too high a level. That meant internal wages and prices would have to fall to match the external value policymakers wanted to display to the world. In plain terms, the country was choosing the prestige of a strong currency over the tolerable adjustment of the people living under it. Keynes warned that the burden would land first on the export industries, then spread through unemployment and wage pressure, and finally be enforced by tighter credit if necessary. He called it asking for trouble. He was right. What mattered was not simply that the pound was overvalued. What mattered was the adjustment mechanism. A country can defend a prestigious currency in two ways. It can become genuinely more productive, lowering real costs through growth and innovation, or it can force costs down through pain, through unemployment, through wage compression, through debt deflation, through regional decline. Britain chose a version of the second path. That was the deeper lesson. Currency strength is never just a number. It is a social decision about where the strain will go. If the exchange rate is treated as sacred, then labor markets, industrial districts, and indebted households become the shock absorbers. Britain paid for monetary prestige with industrial weakness and social tension. The symbolism of national strength survived longer than the broad economic base underneath it. And once that pattern appears, it becomes hard to unsee. Financial credibility can remain intact long after the productive social contract begins to fail. Now bring that pattern forward to America. In the early 1980s, Paul Volcker's Federal Reserve pushed interest rates high to crush inflation. At the same time, Ronald Reagan's fiscal expansion helped raise long-term rates and draw foreign capital into the United States. The result was a spectacularly strong dollar. To many observers, that looked like a vote of confidence. In reality, it was also a transmission belt for pain. The stronger dollar made American goods more expensive abroad and imports cheaper at home. That sounds manageable if you speak in aggregates. It sounds very different if you live in a manufacturing county, a farm town, or a city whose middle class is tied to production. By February 1985, the Federal Reserve's major currency dollar index had surged from 93 in September 1980 to 144. The U.S. trade deficit hit records. This was not a sign that the American economic model had become perfectly balanced. It was a sign that the financial mix of tight money, high real yields, and capital inflows was overpowering the industrial base. This is where the story turns. When people say a strong dollar helps consumers, they are not entirely wrong. Imported goods can become cheaper. Foreign travel can feel more affordable. Inflation pressure on traded goods can ease. But those benefits are narrow, uneven, and often temporary. The costs strike at the architecture of middle-class life. A family cannot build security on slightly cheaper imported electronics if the industries that once supported upward mobility are losing competitiveness. A town cannot replace stable production with a permanently stronger currency and expect identical social outcomes. A nation cannot watch capital pour into its financial assets while its tradable sectors are squeezed and pretend these are unrelated events. That is why the Plaza Accord mattered so much. America and its allies were not trying to weaken the dollar because the country had suddenly become poor. They were trying to weaken it because the very forces making the dollar look strong were destabilizing the real economy. The strong currency was the symptom of a model drifting out of balance. And yet, even that episode is only one layer of the pattern. Because the modern American economy did not solve the contradiction after 1985, it adapted around it. It became even better at attracting capital, even more dependent on asset markets, even more comfortable with trade imbalances, and even more unequal in the way growth is distributed. The old middle-class bargain in America was built around production, wage growth, and accessible asset ownership. A household could work, save, buy a home, and gradually convert labor into security. The new bargain is different. It is built around the inflation of financial assets, the protection of collateral values, and the survival of households in sectors where prices no longer behave like ordinary consumer markets. That distinction matters because different classes own different balance sheets. Federal Reserve research shows that households in the middle of the wealth distribution tend to hold most of their assets in physical forms, such as housing and vehicles, while households at the top are far more heavily invested in stocks and private business equity. Between the 25th and 99th percentiles, housing is the largest asset and mortgages are the largest debt. At the very top, equities and business ownership take over. That means monetary and financial conditions do not reach everyone the same way. When policy, liquidity, and global capital flows boost equities and business valuations, the gains do not cascade evenly through society. They land hardest where those assets are concentrated. The Federal Reserve has documented that the wealthiest 1% of families hold 57% of publicly traded equities and private business wealth. From 2010 to 2016, the value of business and equity assets nearly doubled and accounted for nearly half of the growth in aggregate household wealth. In other words, the asset boom that followed crisis stabilization was not simply prosperity in general form. It was prosperity routed through ownership structures already concentrated at the top. Now place that beside a strong dollar. When the dollar rises because U.S. rates are high, because treasury markets remain the core of the global system, or because the world is running toward American assets during stress, the direct beneficiaries are rarely the people whose wealth is mostly wages. They are the institutions and households closest to financial ownership, fixed income market credibility, and asset repricing. For everyone else, the balance looks different. Their largest asset is often a home they increasingly struggle to buy. Their largest liability is the mortgage attached to it, or the rent that replaced it. Their exposure to the stock market is real but shallow. Their paycheck is tied less to global capital inflows than to the cost of living in domestic systems that are not disciplined by import competition at all. This is the crucial asymmetry. A strong dollar can cheapen some imported goods, but the biggest bills in middle-class life are not container ship purchases from abroad. They are housing, healthcare, education, insurance, utilities, childcare, taxes, and interest payments. Those are domestic, regulated, monopolized, land-constrained, or heavily financialized sectors. The exchange rate does not rescue families from them. Often, it distracts from them. That is why a country can have a strong currency and an anxious public at the same time. The currency is measuring global demand for the nation's paper. The public is measuring the cost of living inside the nation's institutions. These are not the same thing. Look at the American household now. Federal Reserve survey data for 2024 found that 37% of adults said monthly spending had increased from a year earlier, while only 32% said income had increased. 60% said changes in prices made their financial situation worse. 17% said they had not paid all their bills in full in the previous month. 28% went without some form of medical care because they could not afford it. Those are not fringe conditions. They are the texture of a stressed middle and lower middle society, and they persist in a country whose currency still dominates global finance. Housing makes the contradiction even starker. In 2024, 63% of adults owned their homes, but ownership was sharply divided by income. Only 35% of adults with family income below $50,000 owned a home, compared with 85% of those with income above $100,000. Among renters, the most common reasons for renting were brutally simple. They could not afford a down payment, could not afford monthly mortgage payments, or could not qualify for a mortgage. Median reported rent rose to $1,200, up about 10% each year since 2022, and 21% of renters reported being behind on rent at some point during the year. This is what middle-class erosion looks like in its modern form. Not just lost factory work, though that mattered. Not just wage stagnation, though that mattered too. It is the conversion of ordinary shelter into a leveraged asset system, the conversion of healthcare into a cost shock, the conversion of education into a debt instrument, and the conversion of national economic prestige into something people can see everywhere except in their own monthly budget. And this is where the strong dollar becomes such a deceptive signal, because the dollar often rises when the world is afraid. It rises when geopolitical risk intensifies. It rises when U.S. rates outpull other markets. It rises when global investors want liquidity, collateral, and the depth of treasury markets. The IMF noted in 2024 that the dollar's valuation had been supported by the robustness of the U.S. economy, tighter monetary policy, and heightened geopolitical risk. In other words, the same conditions that make the dollar look dominant can be conditions of stress, fragmentation, and defensive capital allocation. A strong dollar, then, is often less like a trophy and more like the blinking light above a panic room. People run there because the building is unsafe. The room itself may be reinforced. That does not mean the structure around it is healthy. America has become the world's panic room. That status carries real privileges. The U.S. government can borrow on extraordinary terms compared with most of history. The Treasury market sits at the center of global finance. Even now, the dollar remains the preeminent reserve currency, despite a gradual decline in its share of official reserves over the last 2 decades. That durability gives the United States time, flexibility, and geopolitical reach that other countries do not enjoy. But privilege at the sovereign level does not guarantee coherence at the household level. In fact, it can postpone the reckoning that would otherwise force reform. A normal country that hollowed out parts of its industrial base, ran large imbalances, inflated asset prices far beyond wage growth, and accumulated vast public debts would face a faster market discipline. Its currency would crack sooner, its borrowing costs would spike sooner, its living standard would be forced into abrupt adjustment. The United States experiences a different sequence. Because the world still wants dollars, treasuries, and access to U.S. financial markets, the system can absorb more contradiction. It can sustain debt longer. It can socialize losses through the state more easily. It can protect the value of paper claims longer than it can protect the social arrangements beneath them. That would already be serious enough, except the fiscal side of the story is now catching up. According to the Congressional Budget Office, debt held by the public is projected to reach 107% of GDP by 2029, higher than the previous record set after World War II, and then keep climbing to 156% of GDP by 2055. Net interest costs are projected to rise from 3.2% of GDP in 2025 to 4% by 2055, exceeding all discretionary spending by 2052 and consuming more than a quarter of federal revenues by 2055. Those numbers matter because they tell us what the state will increasingly be asked to defend, not simply prosperity in the abstract, not simply public goods, but the credibility of an enormous debt structure at the center of the global monetary system. When a country reaches that point, monetary choices become politically loaded in a new way. Keep rates high, and you defend the currency, contain inflation, and preserve bond market confidence, but you also pressure housing, credit, business formation, and labor markets. Let rates fall too aggressively, or tolerate renewed inflation, and you relieve debt pressure temporarily, but you risk undermining purchasing power, reigniting asset speculation, and weakening the same middle-class savers already punished by the last cycle. Either path can wound the middle if the structure underneath remains unchanged. That is, the broader framework tying this entire history together, Britain under sterling, America under the dollar, different eras, different institutions, same hidden choice. When policymakers elevate monetary prestige, external credibility, and asset market stability above the renewal of broad productive life, the currency can remain strong even as the social contract weakens. The public senses this before it can articulate it. That is why people can hear that the dollar is strong and feel almost insulted by the sentence. They know their grocery bill. They know their insurance premium. They know what happened to home prices relative to income. They know that every year of supposed national strength seems to require more strategic sacrifice from families who do not own enough of the assets being protected. And this is the part most people miss. The middle class does not need the dollar to collapse in order to be broken by the dollar system. It can be squeezed by strength. It can be squeezed when high yields pull in capital and mortgage costs surge. It can be squeezed when a strong currency suppresses tradable sector dynamism while domestic essentials keep climbing. It can be squeezed when asset inflation rewards ownership but punishes entry. It can be squeezed when policymakers treat market confidence as a proxy for national health. Collapse, in this sense, is not always a cinematic crash. Often it is a long institutional transfer, from labor to assets, from wages to collateral, from households to balance sheets, from places that make things to places that price things. That slower collapse is harder to dramatize, which is why it gets mislabeled as resilience. The country still functions, the bond market still clears, the currency still rallies in crises, the stock market eventually recovers. The official architecture remains standing, but beneath that appearance, the ladder narrows. The household with no home gets locked out of the main appreciating asset. The homeowner becomes dependent on low rates and rising paper equity instead of productive income growth. The renter subsidizes a housing scarcity regime that turns shelter into leverage. The worker in an exposed sector competes against a currency he did not choose and a global capital structure he does not share in. The saver earns little in the easy money years and pays more for everything in the aftermath. Each one of these outcomes feels separate in daily life. They are not separate. They are connected by the same macro structure. This is why the story cannot be reduced to partisan slogans or one central bank decision. The dollar's strength is not, by itself, the villain. A reserve currency is not, by itself, a curse. The problem is what kind of domestic economy grows around that privilege when reform is deferred and financial depth is allowed to substitute for social depth. A nation can live for a long time on the reputation of its institutions, the size of its markets, and the safe haven demand for its debt. The question is, what happens to the people inside that nation while the reputation is being monetized? If dollar strength were the same thing as middle-class strength, America would be entering a golden age of household security. It is not. If asset market depth were the same thing as social stability, the country would not be dividing so sharply between owners and entrants, incumbents and strivers, paper wealth and earned income. If reserve currency privilege automatically translated into broad prosperity, the public would not feel this persistent mix of exhaustion, suspicion, and decline beneath the headline numbers. So, when the next surge in the dollar arrives, and it will, the surface story will sound familiar. Commentators will call it confidence. They will call it resilience. They will call it proof that the United States remains the indispensable anchor of the system. But stop there, and the real signal is lost. Ask instead what is happening to mortgage rates. Ask what is happening to the cost of entry for first-time buyers. Ask whether the rise is being driven by genuine productive renewal or by fear, flight, and rate differentials. Ask who owns the assets being repriced upward by the same conditions that are pricing others out. Ask whether the country is becoming stronger or merely more central to a world in distress. Because that is the final reframing. The dollar's strength does not answer the question of whether America is healthy. It raises the question of what kind of health is being measured. Is it the health of households, towns, wages, and family formation? Or is it the health of collateral, capital inflows, state borrowing capacity, and financial market trust? Those are not identical things. In long cycles of imperial finance, they can move in opposite directions for years. The tragedy is that a reserve currency can keep flattering a nation long after it has stopped serving its middle.